Hey everybody, I'm sitting out here doing some evening work, having a beer on my computer on Bigger Pockets, and I've been a lot more active on Bigger Pockets lately. I've been posting a whole bunch and talking to all these investors and talking to a lot of investors from California and Washington and Oregon and these expensive cities. And they're starting to have trouble finding good deals out of state, or they're going out of state and they're settling for like 10% returns. And people keep saying it's hard to find a good deal. It's hard to find a good deal. It's hard to find a good deal. That's nonsense. It's not hard to find a good deal. You're looking wrong. Learn to define your good deal a little bit better. And that's something that my business has taken and made a top priority lately is characterizing our ideal product. We spend a lot of time with our ideal customer profile. Who's the seller that's going to give us a good deal? But we didn't spend a lot of time with our ideal product. And as soon as we started thinking about our ideal product more, we started finding more cities to invest in, not just our one unicorn market of Northwest Indiana, but we started finding more markets all over the Midwest and even parts of the South to invest in that work, because we started thinking of it the right way, right? If you don't know about us, Ace Properties, our company, is focused on providing out-of-state rental properties to investors primarily in big cities who can't really get the returns they're looking for in these big cities. And our niche is ultra high cash flow. I mean, other companies provide a 10, 12% return. We have to provide a 20, 25, and sometimes higher cash on cash return with financing, or a 10 to 12 cap when everyone else is operating in a 7 to 9 cap, right? And we have to think differently to find these deals and to be scalable as a business. And what we've thought up to find the ideal property for maximum cash flow and what the profile is for it is this. So number one, through observation, doing hundreds of deals over the, well, not hundreds, okay, I'm embellishing ourselves. We're a 2-year-old company, really 3 years, but 2 years of selling property. We've done a little over 100 small apartment building flips, 2 to 8 unit buildings. And what we've noticed is there's a price range where things tend to work. And there's a price range above that where things don't tend to scale, and a price range below that where things are just too cheap. They don't tend to work anymore. And that price range is the $50,000 to $70,000 single family home. Guys, really listen to what I'm about to give you. It's gold. It's like our company's inner secrets here that I'm just kind of handing out. And yeah, I'm hoping that you get some interest in working with us here and potentially becoming a buyer, because we're expanding to all these new markets. But really, you could take this information, just run with it yourself. So listen up. The $50,000 to $75,000 single family home. I'm not saying everything in that range works, but nothing outside of that range has ever worked for us. $50,000 to $75,000. The duplex, this is our most common product. The duplex between $80,000 and $120,000 market value, and really lower than that, 80, yeah, I would say 90 to 110. That's really our sweet spot there. And 110 if it's a big duplex with big 3-bedroom units. But really that $90,000, $100,000 duplex, that's where the money's at. The 3-plex, 125 to 160 if it's a big one. That's where it works out. The 4-plex, that's 140, 150 to 180. Don't go above that. Those price ranges are where the money's at. Now go find markets that have a lot of product in those price ranges, and you will find something. The next thing is asset class. Stop. Just please stop going for B-class assets. Stop going for B-class assets. I don't care what they say on Bigger Pockets. Stop going for B-class assets. B-class assets have people with jobs that do this. They go up when the economy's good, and they go down when it's bad, and they are nitpicky and want everything fixed a million times over. And guess what? They can't afford these high rents in these properties, and those properties cost you a lot more, and they don't cash flow. C and C plus, right? Maybe B minus. But there's an abundance of high cash flow product available in a lot of Midwestern markets in C plus neighborhoods, but they're not heavy enough on crime, or poor enough in schools, or undesirable enough in general for these neighborhoods to not have healthy tenant demand if the rest of the market has a healthy tenant demand. C plus neighborhoods, guys, that's our bread and butter. That's the working class neighborhood that has some Section 8 tenants in there, and it has crime rates that might scare away other investors. But when you call the property management company and say, do these units fill? How quick do these tenants stick around? They say yes. and the rents are still strong. In fact, the rents are usually pretty similar to the B-class neighborhoods, just half the price on the purchase price, because you're not competing with other investors the same way. The theme of this is competition, and we're going to kind of jump into the most important detail here. All these other two things, these are criteria that you could filter by. C assets, C plus assets, 80 to 100K on a duplex, 140 on a triplex, whatever you want to call it. But this next thing is something that's a little bit more straightforward, but no one gets it. It's not numerical. It doesn't require investor skill to do this. Stop going to major markets. Just stop going to major markets. If you're from California and you live in San Francisco, you might look at Kansas City and go, wow, those things are cheap. They still don't cash flow. Learn to run a pro forma. It's still a 10% cash on cash return or a 12% cash on cash return. I don't care if it's cheaper than San Francisco. You are not buying an investment based on its comparative value to the market you're in. You are looking at it objectively and looking at the yield. And guys, we're in 2019. You're buying everything for way more expensive than it's supposed to be bought for right now. I don't care what market you're in. You're overpaying. Accept that reality. And if you still want to invest in rental property, which you should play all four quarters. You've got to make the smart decision. You've got to go for the high yield property. You got to go where you're not competing. And look, if you're in California and you're saying in 2019, I want to invest in Kansas City or Indianapolis or Cleveland, I'm sorry, you're really late to the party. You're very, very late to the party. People had this idea 4 or 5 years ago. I passed on Kansas City and Indianapolis in 2016 when I started this business because it was not going to check out then. Guess how much hotter it is now. Go to secondary and please tertiary markets, places where the local investors are not as involved. There's not as much competition. They're less sophisticated. And the out-of-state investors, they just didn't spend the effort to think about it. They go where there's a ton of turnkey providers and a ton of companies that have access to a large housing supply to flip and sell to California investors. That's why Memphis is so inflated. There's so many people that know about Memphis because of big companies in Memphis that sell rental property for crappy returns, guys. You don't want crappy returns. Get the hell out of Memphis, get out of Kansas City, get out of Indianapolis. I like Northwest Indiana. East Chicago, Indiana is a gold mine. LaPorte, Indiana is a gold mine. Racine, Wisconsin is a gold mine. Appleton, Wisconsin is a gold mine. And there's many more where that came from. Look, I want to say something very realistic here. There are a million other investors out there who are willing to make less money than you or I. And I don't want to compete with them. I don't want to compete with them. I want to compete with the folks that expect a higher return than me. I want to be the person that's willing to pay more, right? Not the one who's getting outbid on these properties. So think of these factors. This is competition. This is how you make it in 2019. And this is how you find abundance and carve yourself a niche where you're in blue waters. Right? You're not competing with all the other sharks out there. There's no blood in the water. No one smells it except for you and a few select others. That's what we do as a business. We find these markets that are blue water markets, right? Where you're not having to fight for good deals, even in the hardest time we've seen in this past market cycle to find good deals. Keep thinking outside of the box. Keep going where other people aren't going. You will find 20, 25%, 30% returns on properties. And if you don't want to do the work yourself, give us a holler. We'll find it for you. We've already got the management companies in place. All these markets are highly viable, and there are more of them. Cheers.